Hello, everyone. Here you have Don Lonczak and my partner Steve Marcus from Baker Botts. Today's discussion is on the recent tax law changes and their impact on the real estate industry. To begin, we have a new tax act, a very long name due to Senate procedural issues, for which we informally refer to as the Tax Cut and Jobs Act of 2017. The Act has a number of provisions that could be relevant to real estate investments, including investments through REITs. We will review the new rules in the coming slides, but worth noting up front that some of the more favorable rules are subject to expiration after 2025 unless extended by later legislation. Okay, before getting into the detail, we provide here a high-level overview of the key takeaways from a real estate standpoint. First, we have significant rate reductions pretty much across the board. A new corporate rate that is permanently set at a flat 21%. That's coupled with an up to 20% deduction for the business income of pass-through entities that has the effect of reducing the tax rate on that income below a new maximum rate for individuals, estates, and trusts of 37% to what would be a maximum rate of 29.6%. And correspondingly, a similar 20% deduction for REIT dividends, part of the same rules, that gets REIT dividends to the same 29.6% effective rate. And again, as mentioned earlier, these rates for individuals, pass-through entities, and REITs would be subject to sunset after 2025. Next, there now is a broad limitation on interest expense deductions, basically set at 30% of the taxable income computed without regard to interest deductions. The good news here for the real estate industry is that there is an election out of the limitation for real estate businesses, with that election out coming with the requirement that the real estate businesses would need to adopt a different method of depreciation than the typical makers. Although, as we discussed earlier, the differences are not all that significant. Finally, on this page, we note that the limitation on interest expense generally is not applicable to government-owned utilities as well. Moving on, the existing bonus depreciation deduction available for tangible personal property has been increased to a full 100% expensing in year one for a 5-year period beginning in 2018 and a phase down starting in 2023. And as part of this new bonus depreciation regime, it's been expanded to include used property as long as we have a buyer who is acquiring the property for its first use. Thus, I think bonus depreciation will become an attractive attribute for consideration in M&A deals. Next on this page, the long-anticipated change to the taxation of carried interest of fund managers has become a reality, but on a more limited basis. Basically, the preferential rate for long-term capital gain income will remain available for carried interest, but only if a 3-year holding period is satisfied, as opposed to the typical 1-year holding period that was imposed under prior law in order to attain the benefit of the lower rates. Also, the pesky rule for technical terminations of partnerships is gone. Under prior law, a technical termination was triggered on a 50% or greater sale of a partnership interest and could have some negative tax consequences mainly including the restart of depreciation recovery periods for the assets held by the partnership under the new Tax Act. Concerns about terminating a partnership upon the sale of a partnership interest have been eliminated. Capital contributions to corporations. Under prior law, these contributions generally were treated as tax-free with certain exceptions. The House bill had proposed some meaningful changes to the tax treatment of capital contributions, but the final act is more limited. In short, a corporation cannot benefit from tax-free treatment under the act for contributions from a governmental entity unless the government is a shareholder and making a contribution in its capacity as such. Also, in connection with its work on this subject, Congress has, quote-unquote, clarified that tax-free treatment of capital contributions is not available to partnerships with respect to contributions from non-partners. So, to the extent there was doubt beforehand, the ability to make a tax-free capital contribution to a partnership other than as a partner is not available in the eyes of Congress. We also have a new limitation on the deduction of NOLs, where under the Act, NOLs can only offset 80% of taxable income in any given year. The limitation probably can be viewed as a trade-off for the elimination of AMT for corporations, but this new limitation applies to all taxpayers, even though AMT was only eliminated for corporations, and individuals remain subject to a potential AMT on top of this NOL limitation. As part of the same rules, the NOL carryback has been eliminated, such that NOLs now may be carried forward, albeit on an indefinite basis, but can no longer be carried back for 2 years. And tax-free treatment for like-kind exchanges. No longer available for personal property under the Act. The beneficial rule remains available for real estate swaps, which of course is very important to the real estate industry generally. And then finally, Congress has reversed the holding of a recent tax court decision that held that a foreign partner was not subject to U.S. tax on the sale of a partnership interest if the partner would not have been subject to U.S. tax on the sale of the underlying assets of the partnership. In fact, the rule of the tax court had been that the sale of a partnership interest was a sale of a capital asset, and that was determined without regard to whether or not the income from the underlying partnership was effectively connected income for a foreign taxpayer or not. By reversing the decision, Congress has adopted the approach that the IRS had in effect for many years, but that was often questioned by tax practitioners. And we'll discuss that a bit more later. So next, I think we'll just start with a quick reminder of the applicable federal tax rates prior to the enactment of this tax reform, in case anyone forgot. So as shown on the slide, we've got C corporation structures with a 35% tax rate at the corporate level, and then an additional 20% tax on qualified dividend income flowing through to individuals. In contrast, for pass-through type structures, just a flat 39.6% rate at the maximum level on the income, but then adding on, where applicable, the Medicare tax of 3.8% for dividend income, and frankly, most pass-through income that's generated and allocated to individuals. Next, we have an example here of potential tax costs pre-2018, comparing C Corps to partnerships. So on the slide, we have $1,000 starting point for taxable income, with $350 of corporate tax being incurred on that with a 35% rate, additional $130 tax on QDI, $25 of Medicare tax. So we have an all-in tax on corporate earnings of $505 out of a total of $1,000 of income. And then we can contrast that with a pass-through structure where there is no corporate level tax. The individuals participating in the partnership have a $396 of tax at the partner level, adding in $38 of Medicare tax for a total of $434, thus highlighting a significant difference in the tax rate between the two structures. So translating the tax costs on the prior slide into percentages, you've got a 50.47% rate for corporations, 43% or so for partnerships, and a benefit to the partnership structure of a little over 7% under prior law. Next, we can turn to where things stand today with the Tax Reform Act, and we now see that we have C Corps with a permanently reduced tax rate of 21%, individuals only slightly reduced to 37%, and significantly that rate is scheduled to expire in 2025 unless future legislation extends it. The big game changer here is, of course, the pass-through deduction under new Section 199A that provides a 20% deduction for business income in relevant cases for a pass-through that has the ability to reduce the individual tax rate to 29.6% when applicable, but again, subject to expiration in 2025 unless extended. So comparing old to new, we have is C Corps benefited from the tax law change to the extent of 14%. Pass-throughs and individuals only got a slight benefit of 2.6%, and then other tax rates generally remain the same. Again, we can look at some numbers to compare the tax costs of old law versus new law, and what we have here is the tax on the C Corps went from basically over half of total income to now at $398, and compared to partnerships without taking into account the pass-through deduction under 199A would find themselves at $408 and paying more tax than the C Corp structure. But then if we factor in the 199A deduction where available, we see that partnerships pass-through structures generally get to a more favorable result than the C corporations. And again, putting all this into percentages, basically what we see is that based upon the Tax Reform Act, we have corporations enjoying a 1% benefit over pass-through structures without regard to the 199A deduction. But if we factor in 199A, we go the other way, and we find a 6.4% benefit in partnership structures. So, in summary, what we have is C Corps going from pre-act to post-act with a 10.67% benefit and rate differential. In pass-through structures, going from getting a 2.6% benefit or a 10% benefit if the 199A deduction is available. So moving beyond the strict C Corp versus pass-through comparison, it's just worth noting quickly that the analysis holds true for REITs as well. In the REIT context, we have C Corps moving from the 50.47 to the 39.8 all-in, but with a pass-through deduction made available to REIT dividends under the new law. REITs now move from 53.4% under prior law to a rate of 33.4% all-in for a slight for maintaining their advantage in corporate versus REIT investments with some modest reduction in that benefit, essentially under the law. Now we see that prior to 2018, the benefit was at 7.1%, and it's moved down slightly to 6.4% under the new law. Like the rules applicable to pass-throughs generally, the REIT rules are going to expire after 2025 unless extended through future legislation, and that's contrasted to the corporate rate of 21%, which is permanent at this point in time.
All right. As Don pointed out in the prior slides, operating through a pass-through entity maintains its benefit over a corporation only if the pass-through entity's owners are entitled to the 20% deduction or exemption. We'll drill down a little bit in these next slides as to what it takes to qualify for that 20% deduction or exemption. The statute specifically says that subject to certain limitations, which we'll talk about in a minute, the deduction applies, 20% deduction applies to qualified business income of the taxpayer. It doesn't apply to corporations, but in cases where the deduction does fully apply, the top individual rate is effectively reduced from 37% to 29.6%. The deduction does not apply to the net investment income Medicare tax. That still stays at 3.8%, just like it was under prior law. The deduction is actually applied at the partner level in the case of investments in partnerships and LLCs. Okay, in order to qualify, again, the deduction, the taxpayer has to generate qualified business income. Qualified business income is any net income that's connected with a qualified trade or business other than certain types of investment income. So income like dividends, non-business interest, and capital gains would not qualify. On the other hand, rental income from commercial real estate will generally qualify. There is an exception that says that no income from businesses conducted outside the United States qualifies. So this 20% deduction is limited just to income from U.S. businesses. A qualified trade or business is generally any trade or business other than a specified service trade or business. Specified service trade or businesses are really businesses that involve performance of personal services. So healthcare services, legal services, accounting, consulting services, financial services, and brokerage services businesses, none of those would qualify for this special exemption. As a result, earnings from those businesses are going to be subject to the 37% tax rate, will not be eligible for any portion of the 20% deduct. Specified service business also includes any other type of business, the principal asset of which is the reputation or skill of one or more of the owners or employees of the business. Finally, specified service businesses specifically include businesses that consist of investing in investment management, trading or dealing in securities, partnership interests, or commodities. So I think as applied to real estate, you know, one of the questions that I've seen come up is, what about real property management services or development, fees for development services or asset management? I think those are likely to get swept up in the specified services definition. The reason being is I think they're likely to be considered consulting services or services that really involve the reputation or skill of one or more of the employees or owners. There isn't any guidance on this, though, at this point, so, you know, I'd imagine some folks may want to take a more aggressive position, at least until guidance comes out. But, you know, I think it's likely that that guidance will sweep up those types of real property services that I mentioned. Okay, the 20% deduct, that's the maximum deduct that you potentially receive. That deduct is limited, though, by what we've called the W-2 limitation on this slide. That limitation applies to taxpayers whose taxable income exceeds certain thresholds that we've laid out in the slides. Assuming the taxpayer's income does exceed those thresholds, the deduction that they're entitled to is going to be limited to the greater of half of the W-2 wages paid with respect to the qualified trade or business, or the sum of 25% of the W-2 wages paid, or 2.5% of the unadjusted basis of the qualified property used in the trade or business. That latter limitation or piece of the limitation is very important in real estate. In fact, during the legislative process, the limitation early on was solely by reference to W-2 wages. As most folks listening in probably are aware, most entities that own commercial real property don't themselves have employees. As a result, those entities aren't paying wages. Because of that, strictly a wage limitation would probably result in a zero deduction. This other piece of the limitation, 2.5% of the unadjusted basis of the property held in the qualified business, it was really added at the behest of the real estate industry, and as a result, probably takes most commercial real estate investments out of this limitation and allows them to obtain the benefit of the full 20% deduct. In the case of partners and partnerships or members of LLCs, in order to apply these rules, the partner or member takes into account its share of qualified business income, W-2 wages, and unadjusted basis of the property owned by the partnership or LLC, and then the partner calculates its deduction outside of the partnership or LLC. W-2 wages are what you think they would be. It's basically just all wages and other compensation, including deferred compensation, paid by the qualified trade or business. Qualified property, which is the important prong here, is any tangible property subject to depreciation, whether real or personal. Obviously, it wouldn't include land itself because it's not subject to depreciation, but any commercial buildings or residential buildings would be included in qualified property. There is one caveat, though. The depreciable period of the property has to have not yet ended in the taxable year in which you're claiming the deduct. That shouldn't be a very difficult requirement to meet, since buildings typically have very long lives, in particular commercial real estate. Non-residential real estate has a 39-year depreciable life. So unless you've held the property for a very long time, generally you're going to be able to include its basis for purposes of calculating this limitation. And as a result, in most cases, should get the full 20% deduct. We've laid out a pretty simple example that kind of shows why, for most real estate, the W-2 limitation isn't a big deal. In the example, we're assuming that a fund buys a piece of real estate, commercial real estate, for $100 million. The entity has no employees, and it has $4 million of net rental income exclusive of depreciation, and depreciation of $2.5 million. Therefore, the entity has taxable income of $1.5 million. All of that income is rental income, so it should be good qualified business income. If you apply the deduction limitation, what you end up with is the sum of 25% of zero being the wages paid by the entity. But then you get to add to that 2.5% of the basis of the entity's property. And I'm assuming none of that basis is land, but you'd end up with a limitation of $2.5 million. which is well in excess of what's needed in order to obtain the benefit of the full 20% deduction. The 20% deduction also applies to REIT dividends. In particular, 20% of any qualified REIT dividends are effectively exempt from taxation. Qualified REIT dividend definition is very broad. It's basically any REIT dividend other than capital gain dividends and other than the portion of a REIT dividend that effectively is what it's paying out that it received from C corporations, in other words, qualified dividends. That's a pretty small subset of REIT dividends. As a result, most all REIT dividends will qualify for this deduct. In addition, this particular 20% deduction is not subject to any W-2 wage limitation or any other limitations. So because of that, REIT dividends will have an effective income tax rate of 29.6% or 33.4% if the net investment income Medicare tax is taken into account. Similarly, any real property income earned through pass-through entities in most cases will enjoy the same 29.6% maximum tax rate plus potentially the 3.8% investment income Medicare tax. As Don indicated earlier, the bad news is both the 20% deduct and the reduction in individual rates are scheduled to expire after 2025 unless additional legislative action occurs before then that extends those rates. Because the C corporation rates are permanent, if the 20% deduct and the reduced individual rates are not extended, as Don showed on those prior slides, C corporations would actually enjoy a rate advantage over REITs and other pass-through entities. Because many, if not most, of the favorable provisions in the Tax Act are scheduled to expire after 2025, there's probably a pretty good likelihood that future legislation will extend at least some of the benefits that are currently in the Act that are scheduled to expire in 2025.
Okay, next we're going to move into the new interest deduction limitation under 163J. Formerly, 163J was basically an earnings stripping limitation on related party interest payments, but now under the new law, it's a much broader limitation applicable to all businesses, regardless of whether they're in C Corp or pass-through form. Basically, the limitation is 30% of the adjusted taxable income of the taxpayer, unless you're a car dealer, in which case there's certain favorable adjustments that are made to the calculation of adjusted taxable income. The limitation under 163J applies in addition to and after other limitations that are applicable under the code, and that would be existing limitations as well as some new limitations that came in the foreign context. The limitation has special rules for partnerships, but generally the limitation is applied first at the partnership level before taking into account what's happening at the partner level. And finally here, any excess interest deductions that are limited by 163J are available for carry forward on an indefinite basis, which is consistent with 163J under its prior form. So, with all that said, very relevant to this new calculation is the determination of adjusted taxable income to which the 30% limitation will be applied. A significant note here basically is that business interest expense is added back, interest income is added back, the 199A deduction that Steve just discussed is added back, and most importantly, at least prior to 2022, there is an add back for depreciation and similar deductions. So there is a favorable aspect to the law, at least for years prior to 2022, because a taxable income gets a boost by adding back depreciation. Quick example here, we have a partnership, two 50-50 partners. Taxable income is 70, but once we add back interest expense, interest income, and depreciation, we end up with adjusted taxable income of 100, so that the 30% limitation becomes $30. In this example, the partnership has interest expense of only 20, with the result that there is no limitation, and in fact, the partnership's in an excess limitation position of $10. Here, and as particularly relevant to the real estate industry, we highlight a number of key exceptions to the 163J limitation. And first one, of course, is for businesses that are related to real property investments. There is an election out where you can elect to apply not apply the 30% limitation. Basically, real property trade of business is defined by reference to the existing rule, passive activity loss rules under 469, and thus includes real property development, redevelopment, construction, and so on. So a fairly broad exception for the benefit of the real estate industry. Other exceptions from the 163J include a small business exception based upon gross receipts that don't exceed $25 million. And then finally, regulated utilities got themselves an exemption if you fall within the definition set forth on this slide. So now I think we can turn to the special rules for partnerships. As mentioned, the limitation first applies at the partnership level, but the limitation also can be relevant to a partner if the partnership finds itself in an excess limitation position, or the partner has its own interest expense that it's seeking to deduct. And here the most relevant thing is that the rules are designed to avoid a double counting of the taxable income of the partnership. So when we get to the level of the partner is required to determine its adjusted taxable income, which is its taxable income without taking into account any income from the relevant partnership, unless that income is considered excess taxable income, which show here is basically the income that was available for offset by the interest expense limitation, but was not utilized. So in this example, we have A Corp as an investor in a partnership. A Corp conveniently has no adjusted taxable income beside its investment in the partnership, but it does have at the partner level $10 of interest expense. So we can start by looking at the partnership. The partnership has a $30 limitation amount, but only used $20 of it, and therefore there's a $10 excess limitation. Basically, that means 1/3 of its total income of 100 is excess taxable income that remains available for shelter by interest deductions. You take that $33 of excess taxable income, move it over to the corporation at the partner level, and A Corp's 50% interest in that excess taxable income is 16.67. Apply the 30% limitation to that, and we've got a limitation amount of 5, which means that of A Corp's $10 of total interest expense, it's allowed to deduct 5 of it, and 5 of it is going to be carried forward indefinitely. Continuing with the special rules for partnerships on this slide, interest at the partnership level is going to be allocated in the year incurred. The carry forward is going to be determined at the partner level, again, to avoid any double counting issues. And finally on this page, and worth noting, is that tax basis in the partnership interest of a partner is going to be reduced by the excess business interest expense of the partner in the year in which it's allocated, but at the time of a disposition, if the partner finds that it hasn't fully utilized that excess interest expense, it's allowed to restore the tax basis. So concluding this topic by considering the impact on the real estate industry, first and foremost, I think the real estate industry is happy because the election out is available, and it's likely to have little impact on the industry as a whole. But for those situations where the exclusion is not available, higher borrowing costs are going to have to be considered because of the loss of that tax benefit. The extent to which the tax benefit is lost is very fact-dependent, and it's going to require modeling to determine whether, in particular cases, an interest deduction limitation is kicking in. In those situations where an interest deduction limitation is relevant, we might find ourselves where we're considering preferred equity investments rather than debt financing. Here we're just going to briefly highlight a number of we're just going to highlight a few other things that are relevant to, potentially relevant to the real estate industry. Here we have changes to the depreciable lives of real estate. This is applicable only if the real estate investor decides to elect out of the 30% limitation on interest expense. In that case, we move from a maker's depreciation to an ADS method of depreciation. Fortunately, based upon the tax rules as they now exist, the move from makers to ADS does not have a significant change in the depreciation periods. The House bill had proposed some beneficial changes to what makers would have been, but it was not adopted as part of the final legislation. So the differences as now are not significant.
All right. Very quickly on bonus depreciation. The Act expanded bonus depreciation on qualified personal property, not on real property, just personal property, so that there's expensing of 100% of the cost of the property when it's placed in service. That's up from 50% under existing law. The 100%, though, begins to phase down beginning in 2023. Another favorable expansion of the rules is that bonus depreciation will apply to used property as well as new property, as long as it's the taxpayer's first use. In other words, the taxpayer didn't formally own or lease the property. Also, there's limitations that prevent taxpayers from acquiring property from related parties and benefiting from bonus depreciation. One question that's come up is to what extent, when a person buys a partnership interest in a partnership that owns qualified property, can the buyer benefit from this bonus depreciation? Unfortunately, the rules aren't at this point well developed. Therefore, the answer is not clear. But I think the way the Section 743B regulations read is that, at least until guidance comes out, you probably have a pretty good position for claiming bonus depreciation on the portion of a Section 743B step-up that is allocable to qualified depreciable personal property. Bonus depreciation does not apply to public utilities or rate-regulated property. One thing it does apply to, though, real property trades or businesses that elect out of the 30% limitation actually can qualify for bonus depreciation. Under prior versions of the bill, they were not eligible to qualify for bonus depreciation. As a result, because of these favorable changes, it may make sense to get things like cost segregation studies done when you're investing in real property to see what portion of the total cost actually can be broken out and allocated to depreciable personal property. All right, the new carried interest rules. Generally, those rules say that any gains from applicable partnership interest will be recharacterized as short-term capital gains rather than long-term capital gains if the holding period for the property sold is less than 3 years. That's a big deal since there's a pretty good sized spread between long-term capital gains rates and short-term capital gains rates. On the other hand, short-term capital gain treatment isn't nearly as bad as ordinary income treatment in one respect. In particular, you can offset long-term capital losses that you have against short-term capital gain. You don't get that offset of losses against ordinary income. The provision appears to apply not only to sale of the partnership interest itself, but also sales of the assets that are owned by the partnership. Finally, there is no transition rule here. The provision applies to any applicable partnership interest no matter when acquired. So if you acquired an interest in 2017 or 2016, you're still potentially subject to this new rule. An applicable partnership interest is really any profits interest in any trade or business that consists in whole or in part of raising or returning capital, and in addition to that consists of investing in, disposing of, or developing specified assets. As you can see from the real specified asset definition, real estate is specifically called out as a specified asset, as are interests in partnerships or securities, although in the case of partnerships, there's a little uncertainty as to whether that includes privately held partnerships. I suspect, though, based on the House report, which we've kind of outlined here, and the fact that the provision particularly calls out real estate, it may be an uphill battle to claim that ownership of real estate through a partnership that's a privately held partnership somehow escapes a grasp of this carried interest rule. A couple of things an applicable partnership interest doesn't include are any partnership interests held by corporations. Generally, this only applies to partnership interests held by individuals either directly or through other partnerships. Use of an S-corp, that probably isn't going to work. Applicable partnership interest doesn't include the portion of an interest that's a capital interest, whether paid for by the partner or received for services and taxed as income. Finally, it doesn't include a partnership interest that management of a portfolio company may get in a portfolio company that's owned by a private equity fund. And under this example, all we're showing is that the fund manager who gets a profits interest in the fund has an applicable partnership interest that's subject to the carried interest rule. On the other hand, management of a portfolio company owned by the fund who receives a profits interest in the portfolio company likely is not subject to the new carried interest rule. Okay, we're going to take a break for a minute to read off the code that you need in order to get CLE credits. I'll read it 3 times just so everybody gets it. 98542. That's 98542. 98542. Now, back to our regularly scheduled programming.
Thanks, Steve. Before I continue on, can you tell me what that number is again?
98542.
Okay, so we're going to wrap this up with just a run-through of some other relevant provisions that's potentially relevant. The first being the repeal of the technical termination rule under 708. Under prior law, if there was a transfer of 50% or more of a partnership interest, the partnership was deemed to terminate and become a new partnership for tax purposes. Largely, it meant nothing except it presented a headache, particularly for real estate, because you had to reset your depreciation periods, and any elections that were applicable to the partnership potentially needed to be refiled. All of the bad tax consequences of 708 technical terminations are now gone. So worth considering whether partnership agreements, LLC agreements can be amended to eliminate any nasty transfer restrictions that are in there regarding 708 technical terminations. Steve mentioned at the beginning, the Act addresses certain concerns that have lingered with Congress over years on Section 118 and the provision that generally allows for tax-free capital contributions to corporations. Specifically, they have now narrowed that exception, and any contributions by a governmental entity are no longer tax exempt. We note here that the Act did not go as far as the original House proposal, which would have just essentially completely eliminated Section 118 tax-free status for capital contributions unless there was fair value received back in the form of stock of the company. And finally, the conference report for this change in law reminds us, in case we didn't know, that the 118 is intended to apply only to corporations, and therefore partnerships or other non-corporate entities shouldn't be seeking the benefit of Section 118. Net operating losses. For corporations, AMT is gone, but we find itself preserved somewhat in the form of a limitation on NOLs, basically to 80% of taxable income for a year. Unlike prior law, which had the 20-year limitation, NOLs under the new law can be carried forward indefinitely, and the 80% limitation applies only to new NOLs. Current law continues to apply to existing losses. Like-kind exchanges, pretty significant change here for the real estate industry. Like-kind exchange treatment remains available for real property, but personal property is no longer eligible for 1031 tax deferral. The result being that the determination between real property and personal property status can become critical in considering 1031 exchanges. And finally, we have the provision that overturns a case that was decided in 2017. The IRS position for a long time had always been that a sale of a partnership interest can give rise to effectively connected income for foreign investors if the underlying partnership was engaged in the U.S. trade or business. That position had always been met with some doubt by tax practitioners, and in 2017 the tax court finally came around and agreed that the rule didn't make sense and held that sale of partnership interest generally was not ECI. The Tax Act basically repeals that court decision and now says that gain on sale of a partnership interest is ECI, and adopts the longstanding IRS position. There is a carve-out from the rule as drafted that income that's related to the real property interest itself is not subject to the rule, but of course, under existing law, gain on sale of a partnership interest is going to be subject to tax under FERPTA. So we have taxation both ways. It's just a matter of which rule you want to apply. Significantly here, the rule is retroactive in its effective date, and therefore would capture any sales of partnership interest going back to November 27th of last year.
All right, that wraps up the presentation portion of our webinar. If anyone has any questions, please feel free to email Megan Green at megan.green@bakerbots.com, and we'll be happy to respond via email. Thank you very much for listening in.